What is a joint venture or JV agreement for real estate in Texas? Are you looking to partner with another investor on a real property investment in Texas? Watch this video for 8 simple tips to include on your next agreement. Ron from Ronald Ruddy Law, and we're a law firm that helps people make investments into commercial real estate. And in particular, we draft a lot of partnership or joint venture agreements, which essentially outline how 2 or more people can come together and join in a LLC, most commonly, and purchase and invest in real estate. Now, there's a lot of reasons for doing that, but you may find it's a great hedge of capital, and you may be able to spread the workload with another partner, or finally, it just might make financial sense to pool some of that risk with another investor. So in this video, we're going to discuss one of the common scenarios for using a joint venture agreement, and that is for 2 individuals to pool their capital into a down payment to purchase a commercial real estate building, maybe an industrial property or a multifamily apartment. So the first question that you need to ask is, what type of entity? Here in Texas, you have a choice of limited partnership, you could have a general partnership, you can have a corporation, or you can have an LLC, a limited liability company. That's probably going to be your most common structure, and it makes the most sense for a lot of people. So, assuming we're dealing with an LLC, the rest of this video is going to discuss what types of terms to put in your operating agreement or company agreement, which is the definitive partnership agreement for an LLC. First section that you need to think about is, what is the purpose? Now, the purpose is usually pretty common, and it may say to purchase, to invest in, and develop or value add XYZ type of real property. We also put a typical catch-all that is up to you if you want to add this, which is a broader any other purpose allowed by law. That protects the LLC in case you start going off into this third tangent. But you may also want to restrict your partner from not being legally permitted to, say, start a vending machine business. Maybe you want to prohibit them from purchasing firearms. So you need to spend a little bit of time to think about how narrow or how broad you want your purpose of the LLC partnership. Another thing that a lot of people ask about is, what are these exceptions for banking or insurance? And this is common in a lot of boilerplate agreements. Basically, there are prohibitions on banking or insurance because those could give rise to personal liability, and you also want to make sure that you're not subject to compliance requirements for those types of regulated industries. What about your members and percentages? This is a very common area of, what is my membership? As a rule of thumb, we don't recommend 50-50 partnerships. We find that those tend to create more problems by creating deadlock and gridlock of members' inability to make decisions. So if you want a close percentage, you can go 51-49%. And even if you want to be closer, you could be 50.1. But at the end of the day, what that does is it creates a dominant majority member, and that allows the 2 partners to break a gridlock and actually make decisions to move forward. Even that tiny 0.1% is going to be a majority decision maker, and that's going to be really key. Finally, talk about distributions. In every LLC, you can divide not only the equity, not only the ownership, but you can divide profits, you can divide losses, you can divide taxes, tax deductions. And so there's a lot of different ways to slice it up and to find a partnership structure that works for you, and understanding you have more flexibility than just pure equity. One of the big areas that we spend a lot of time is who makes decisions. And this ranges not only from day to day, when to call a plumber, how much to pay a landscaping company, or how much to pay to replace the roof on a commercial building, which may cost $100,000 or $150,000. It is important to understand the level and the specific roles of each partner. In a lot of scenarios, I find that there's a natural tendency for one partner to adopt more financial or legal or accounting type roles, and the other partner to adopt maybe more of the acquisitions, maybe the value add, operations, and leasing roles. And these can be informal, but we prefer to see them formally written, at least as a general accountability for each partner to say, I'm intending to be responsible for legal relationships. I'm intending to be responsible for leasing and operations. Certainly the other partner can step in and still have authority, but it prevents arguments and it prevents disputes when one person is trying to do it all, or if there are a lot of tasks to be done, but if they're falling through the cracks, then this document will say clearly, hey, partner B, you're supposed to be responsible for leasing. Please be responsible for this or ask me for help. Finally, for a lot of these decisions, it's important to set a monetary threshold. And that is for certain decisions or costs below a dollar amount. This could be $10,000, $50,000, $100,000. What is the threshold for unilateral decisions of one partner to be able to bind the LLC? It's really critical that you choose a number high enough that allows each partner flexibility and the ability to get their job done without checking for approval from the other partner. But it also is a balance of how much would a invoice cost that the other partner could disagree with and not want to agree to that expense. So again, in my roof example, if you allow for certain repairs to be under $50,000, one partner alone can unilaterally sign off, but you might want both partners to have unanimous consent for any repairs or decisions over $100,000 because ostensibly the other partner could disagree and not want to move forward with that cost of replacement. What happens if there's a deadlock? So this is an important decision. How do you resolve disputes? Or in my roof example, what if one partner wants to replace the roof and says, yes, approve this bid? The other partner says, no, I don't want to approve it. Are you going to require unanimous consent? Maybe you have a third party. Maybe you have somebody else who could weigh in and opine on whether we should move forward or should not. This could be a realtor, this could be your lawyer, this could be any disinterested third party, but that both parties respect. So we always like to put some mechanisms, or at least think about it, and don't put any mechanism in. That is certainly your choice, and you're fully entitled to that. But the point remains to think about it and then make a decision that the two of you want to move forward on. Next is buyout provisions. What happens when you guys really are butting heads? Maybe things are going well. Maybe the property has appreciated in value. What do you do if one partner wants to sell his interest, or he wants to sell the property, but the other partner wants to continue to hold? Do you have a valuation process where you consult a broker, you consult two brokers? Who pays for it? Do you average the values, the broker opinion of value? There's all sorts of different mechanisms that you could put in for a buyout, and it allows one partner to continue with their life and go a different path without necessarily disrupting the day-to-day and the value of the consistency of the building as it stands. So buyout provisions can be very important. Finally, what happens if one partner dies? This may trigger the buyout provisions, but if one partner doesn't necessarily have the liquidity, you don't want to force your partner into a situation where they're a forced partner with the spouse. They became partners with you. They didn't necessarily want to become business partners with your spouse, who may not know anything about real estate. So it's important that in the event that one person dies, the other partner has the liquidity or possibly has a life insurance payout to purchase that fair market value and to pay the estate, to pay the spouse, to pay the heirs or the children. And that way you can ensure that you have the money to pay it out and you're not a forced partner. Or again, you can put some limitations on heirs and spouses. They certainly don't need to make real estate decisions, but they will be entitled to profit distributions, dividends, or other capital benefits of their 50% ownership stake. So that wraps it up. That's 8 different topics to think about on your next JV or partnership agreement for real estate investment in Texas. If you have any questions or if you want to get a Word document, click the link down below and feel free to reach out. Smash that like button, drop a comment if you have any questions, and subscribe if you like the content. We'll see you next time.